post-earnings announcement drift. In financial economics and accounting research, post-earnings announcement drift, or PED, also named the SU effect, is the tendency for a stock's cumulative abnormal returns to drift in the direction of an earnings surprise for several weeks, even several months, following an earnings announcement. Once a firm's current earnings become known, the information content should be quickly digested by investors and incorporated into the efficient market price. However, it has long been known that this is not exactly what happens. For firms that report good news in quarterly earnings, their abnormal security returns tend to drift upwards for at least 60 days following their earnings announcement. Similarly, firms that report bad news in earnings tend to have their abnormal security returns drift downwards for a similar period. This phenomenon is called post-announcement drift. This was initially proposed by the Information Content Study of Ray J. Ball and P. Brown, an empirical evaluation of accounting income numbers, Journal of Accounting Research, Autumn 1968, pages 159 to 178. As one of major earnings anomalies, which supports the counter-argument against market efficiency theory, PED is considered a robust finding and one of the most studied topics in financial market literature. The phenomenon can be explained with a number of hypotheses. The most widely accepted explanation for the effect is investor underreaction to earnings announcements. Bernard and Thomas, 1989, and Bernard and Thomas, 1990, provided a comprehensive summary of PED research. According to Bernard and Thomas, 1990, PED patterns can be viewed as including two components. The first component is a positive autocorrelation between seasonal difference, i.e., seasonal random walk forecast errors, the difference between the actual returns and forecasted returns, that is strongest for adjacent quarters, being positive over the first three lag quarters. Second, there is a negative autocorrelation between seasonal differences that are 4 quarters apart,